Welcome back. Bank Nifty is one of the better performing indexes today. We have to remember that the latest RBI policy has clearly turned the tide in favour of banks by cutting the cash reserve ratio by 100 basis points, entirely unexpected. This allows banks to lend another 2.5 trillion rupees, which they had to keep as idle cash under CRR. The move is so powerful, I would think, that even the beleaguered Innocent Bank has been upgraded today by Nomura, probably partly at least because of this move. It clearly helps everyone's margins and ROA. To get an idea of how much banks benefit from these and other factors, I have with me banking expert Santanu Chakrabarti, the India BFSI analyst at BNP Paribas, that is Banking and Financial Services expert. I'm sorry for the abbreviation. Morning, Shantanu. Thank you very much indeed for joining us. First for banks as a whole, how do you see the margins moving? Clearly, this quarter it's going to be jacked because of the double rate cut, and Q2 may even be worse, isn't it?
Yes. So, whether the margins bottom in Q1 or Q2 would depend a little bit on, what is the mix of repo-linked loans which are adjustable within the first month versus over a 2 to 3 month period. But in any case, some of the adjustment for most people will fall in this quarter, while some of the adjustment will fall in the next quarter. Between Q1 and Q2, there may be slight erosion, and this may differ from bank to bank, but by Q2, you will have the bottom on margins, from which point onwards, margins will actually become a tailwind.
Okay. So, for a typical bank like, say, HDFC or SBI, will the margins in the fourth quarter of FY26 be better than the fourth quarter of FY25 or as good at least?
We actually expect that to be the case, that for most large banks, by the exit margins of the current financial year are going to be better than the one gone by. So the arithmetic on this is very simple. We were going to get about 15 to 20 basis points worst case margin impact directly between this quarter and the next. Now, how that spreads between the two quarters, it depends on the individual banks, but that's the broad impact. But then from that point onwards, you start to get about 4 or 5 basis points of annual expansion from that point, and quarterly expansion from that point. So by the time you get around to exiting FY26, you are going to see meaningful, impact on the bottom margins, whether they are formed in Q1 or Q2 for that individual bank. Now, to give you a sense of how much this could be, we have run a small exercise on how the existing, pre the current rate cut 50 basis point kind of impact that was there on FD rates, that was repricing the currently existing back books of banks on FDs at about 15 basis points on average, which is a fairly, robust number, especially since for most large banks, FDs are now north of 50% of their total demand and time liabilities. And of course, CD rates are also very low at around 6.2%. And there the entire repricing will be done in 1 to 2 months. So all of these become tailwinds, and we are expecting a pickup in CASA as well.
Okay. Now, what is the advantage on CRR cut? Would it be maximum for SBI and HDFC Bank simply because largest in deposits?
Yes, that's one part. Now, the second part of this is how much of this, what does it mean for the overall balance sheet? Does it mean a little more deployment on the investment side? Does it mean a little more conservatism as to what rates you pay on your deposits, or would it mean greater credit? I think it will be a combination of all three, because that's simply how liquidity works. We are yet to see a meaningful acceleration in credit growth. You must have seen the latest numbers, which are running at about 9.9%. So our expectation is that within the next 2 to 3 months, this excess liquidity, especially with the promise of that entire number coming between September and November, loan growth should start to pick up. And that's where a lot of the positive surprises should come from.
No, I'm glad you raised the issue of loan growth, because immediately after the CRR cut, I personally spoke to bankers. there is a problem of borrowers. There is a lack of borrowers. I mean, corporate sector is obviously borrowing from the bond market, if at all it is borrowing. They have excellent internal accruals. Retail, the Reserve Bank has put its controls on unsecured credit with good reason. I mean, I'm not sure that they should even lower them. So where do you lend? Everybody says MSME. Is it really possible that MSMEs can gorge so much credit?
MSMEs in any case are about 15 to 17%. But the growth rate there is very high and there doesn't seem to be any major headwinds. Now, we have a full year system credit growth number of about 13%, Latha. And that actually builds in about 7.5 for corporate loans. So in corporate loans, frankly, I mean, at some point there will be capex, etc. But it is very hard as an analyst to sit down and say that it's going to happen right now, especially given where the global macro stands and the specific nature of the global uncertainties.
Yes,
So,
yes.
I mean, we wouldn't be banking on corporate loan growth supporting it majorly. The only point I'll raise is around retail. See, retail, there's now two positives. One, given how sharply growth rates were pulled back in unsecured loans in the previous financial year, especially in the last 3 quarters of the previous financial year, from this next quarter onwards, growth rates on a year-on-year basis, even without too large of incremental disbursements, start to look a little better. The base
Is
starts to
low,
look
yes.
better. Right.
Yeah.
So,
But
based on that,
Shantanu,
yeah.
sorry, go ahead.
So based on that, I think 15% system retail growth is quite possible this financial year, which
Okay.
I mean, both on the mortgage side and on the other side.
I would assume gold will give a lot of fillip on the retail side.
But the weightage there is low. I mean,
It's very low, very low for banks. It's more an NBFC thing. What about,
Yes.
this is a kind of a casual conversation with only one person who's more an economist and a statistician. He expects infra loans to pick up because, the same point that you make. Why will corporates invest in an era where you don't know which tariff will hit in which country and on which product, which is why corporates won't. But infra is not similarly related. I mean, if it is roads and because of road cement, the government is pretty determined on infra, rail and road, and perhaps irrigation. Do you think, have you done any study of infra loans and can that be a loan puller?
See, I mean, infra loans, I see two major headwinds. One is fairly recent memory of it, right? And where, you talk to any bankers, there seems to be this idea that, let the specialists and, which specific NBFCs I'm talking about, do that. And, we maybe take a back seat. So it's exactly opposite of what 2010-11 looked like.
Okay.
The second part is, I mean, also please think about the provisioning norms which have been proposed. If they come through, it would be very hard. I mean, effectively, you'd be earmarking upfront provisions, half of a NPA to make an infra loan, which makes them very untenable at a accounting level. I don't know how where the dust settles on those norms, but as the norms being proposed, if they stay, then, I mean, infra to a bailout, I mean, these are good. These would be good to have at some point, and I'm sure, given the nature of the problem, some solution will arise. But none of that is baked into our 13% growth number.
Okay. No, I take your point. Actually, even with infra, there are already people complaining that Nal Se Jal project money is not coming. Because it's a central project, they have not given the states and the states are defaulting. Not defaulting, postponing. No, the entire problem of infra is not resolved. But, well, at least a lot of investment activity will happen there, albeit not from the private sector. Okay, Shantanu, now tell me your hierarchy of buys. Okay, we talk about banks.
Yes, so HDFC is, of course, still our topic. We don't think that the valuations fully accommodate the margin story. And as far as, rate cuts stimulating CASA is concerned, HDFC Bank and Axis Bank probably remain the most sensitive to a liability side easing story over the next 4-5 months. Valuations are still favorable. Within NBFCs, we continue to prefer Bajaj Finance because, some of the other NBFC valuations do look a little if not stretched, at least not as attractive as some of the top bank valuations look like to us.
Okay.
So, they appear to be very counterintuitive beneficiaries of easing, but there's a strong case for HDFC Bank at current price. You know my target price and how aggressive it is.
Your target prices are running as you speak, 2770 for HDFC Bank and
Right.
11,120 for Bajaj Finance. Now, I
Right.
take your point. Houses in Altamont Road never come down. So, one has, if you aspire so high, you have to pay the price. Just a final question. Do you see NBFCs having an edge over, a trading buy over banks in the first half, since banks are going to suffer margin loss? And a second and related question somewhat, should we stop looking at margins for banks and look at ROAs? Simply because margins have this peculiarity of EBLR.
Right. ROA is, of course, the ultimate thing that you earn from the business. And as long as your leverage is not, something which in itself becomes a question mark, which on one side would describe PSU banks, on another side, one could make the case. And in fact, Kotak Bank itself said on its call that it's got too little leverage or too much equity. They acknowledge that, right? But other than that, ROA is a very fine thing to focus on because it is the ultimate profitability of the business. There is no major shocks coming either on credit costs or operating costs. So
Yeah.
at least for the rest of the year, margins and ROA would be pretty synchronous for most names, unless specific credit events happen in one two balance sheets. And as far as the NBFC trade is
NBFC.
concerned, as far as the NBFC trade is concerned, and we have discussed this before, Latha. Some of the top tier NBFCs have margins between 800 to 1,000 basis points, and say about 40-45% of borrowing is from banks.
Yeah.
20 basis points on 1,000 basis points, especially when the NBFC would also be repricing their own loans downwards just to improve affordability, gain market share, etc. It's perhaps not the best prism. It noted that their margins are a little better protected in that near term 1-2 quarters than banks, but that is perhaps not the best filter to look at the fortunes of an NBFC. An asset cycle will probably be a better filter, whether that's in growth terms or quality terms.
Yeah, fair point. Point taken. We could go on about NBFC asset qualities as well on a later date. Thank you very much, Santanu, for joining us. Meanwhile, markets have just given up a wee bit, but perhaps it's just a trading profit-taking. Chartbusters will take the action forward.